Good morning, Warriors. How's everyone doing? Richard, Patrick, I echo Ryan's sentiments and Steve's and Bran.
Morning,
How's
Dale.
everyone doing? How's everyone doing today? How you doing, Ryan?
Oh, good, mate. Good weekend.
Yeah, good. Good.
Hey Dale,
Hi, Steve. Nice to hear your voice. How are you?
good. How have you been?
Pretty good. So here we are. A little bit of profit taking and some instruments. Well, it was till I darkened my screen. New highs in Euro. Ryan, your impressions of how we're coming in this week and how much is left in Euro and cable to the
Yeah,
upside? What do you think?
yeah, interesting moves. We obviously got a bit of a dollar rally over the NFP on Friday. As you know, I've been saying that's something to potentially watch to get if it gets sold heavily. You know, people coming in and steaming into selling the dollar if it rallies. That's what happened. Happened a bit quicker than I expected. We saw new highs in a lot of pairs: Aussie dollar, Euro dollar, cable. They just haven't yet.
Across the board.
Yeah, you know, Euro's kicking up near 106 now, but cable isn't really pushing the highs. Aussie dollar isn't really pushing its highs. So I think the early part of this week is going to be about seeing what's going to happen with the dollar. Have we found a temporary bottom? You know, or is there more to be done? And I think the ISM today is going to be maybe a bit of a kicker for it. If you look at something like dollar yen, you know, been on the slide for, you know, as we've seen all the way down, hit that low, couldn't hit that low again since we hit the 133s. So, you know, got a bit of a marker there now, 134, mid 133s to see if we're done or not. So yeah, I'm looking to see what the dollar does in these early sessions at the moment.
Okay, I read from Jim Welsh. He thinks that the market got it wrong on Paul's speech. And since
I agree.
Paul's speech, do you? Okay.
Oh, I do.
Okay. So tell me where the market got it wrong. You know, his opening words was it's possible to start to moderate rate hikes.
I think the market continues to err in the side of over optimism. I think that's more than clear. How do we know this? It's actually quite simple. Powell said nothing dovish. The only dovish things he told us is the things we already knew. What was that? That they would slow the pace of rate hikes, but that was already given.
Yeah, that everyone was already talking only a half in a couple of weeks.
Yeah, but that was already what we expected.
Right. That's what I'm saying. It was already.
Yeah. So did we get something that we didn't expect on the dovish side? Absolutely not. So I think the market continues to err in the side of over optimism, and I think that can prove dangerous.
Look at where we are, Steve. I mean, the downtrend line that everyone, the whole universe is looking at.
Yep.
Probably get a lot of bulls if we close above it.
Yes.
Don't you think? You know, sentiment-wise, anyway. But we haven't yet. I mean, it was a great recovery Friday after Blake shorted it right before the NFP, and it, you know, broke 45, 50 handles. Everything fought back Friday. Are we to make much out of that action? Everything recovered after the initial number being stronger than the market was looking for.
Yeah. In any case, the thing is what we just said. The market has started overextending, and in my opinion, the risk reward has now, started pointing in the opposite direction. Right? I think it's probably a very bad idea to try to chase the market in that direction. There is no reason to believe that risk reward makes sense anymore, both from a technical and a fundamental point of analysis.
Okay. Do you think that this dollar decline is getting a little long in the tooth and getting a little crowded now? I noticed DSI is in the 30s
it's exactly the
now.
same thing we were talking about just now.
Okay.
Because it's the same trade practically, right?
Yeah, you're right. Everything is it's all one market.
Yes.
Right. Okay.
Hey,
Well,
good morning, guys.
yeah.
How are you?
Hey.
Good
Hi,
morning, Blake.
Hey, I wanted to jump in because Dale, you asked Steve a question, and I think it's important because I don't know if he really answered it. You said you asked about the price action. We recovered on Friday,
Right.
and what do you make out of it? I think that's important to really recognize. I don't think anybody should dismiss the fact that we were down aggressively and we rallied back aggressively.
Yeah,
and this is
was
coming from somebody who's short risk, which is me, right?
Yeah.
So I look at the price action on Friday, and it's hard to say, well, okay, well, it's at the beginning of the month, so you got asset managers at work, you got, people are still FOMO, whatever. Fact of the matter is I think while the S&P is above 3,900, if you are short risk, if you are playing, short S&Ps, trying to buy the dollar, whatever you're trying to do, you got to be really careful while we're above 3,900, and especially going into year end, knowing the seasonality aspect of the market. Anyway, I had to throw that in there because I am short risk, and it was concerning on Friday watching it, a lot of the reverse. I took a lot of my short risk trades off, but that doesn't mean that, as soon as the number came out, I ended up covering a lot, but it doesn't mean that I'm not still playing that direction. So anyway, I'll let you go on with everybody else. I just thought that was a really important question that you asked that I wanted to address.
Okay. I well taken. And, for example, today, and we've seen several days like this, Blake, where you've had a weaker dollar that has not translated into stronger S&Ps. And we have another one of those days today. Normally with the Euro up 50, you'd have the S&Ps higher. So they're respecting this resistance, even with what would be a tailwind.
Yeah.
So, just something to keep in mind. It's not the S&Ps don't seem to be leading anymore the way they were. Of course, the star of the show is silver, making its run to 23.5. Let me bring in Stel. Any reason for profit taking here, Stel? And can we now move up the bullish scenario where you should protect yourself if we close back under 22? That's kind of what I'm thinking. 22 is like it was your level, or a lot of people had that 22 level. Is it important that it holds it on any pullback? Stel, if you're here. How about K-Man?
Hey, how are you, Dale? I don't think Stel can make it for the F.A.C.E. So, on silver, I'm watching this. There's a bit going on here around this 23 zone, but indeed, 22 and a quarter, these are all levels that should really hold now. And I must say, looking at the rest of the dollars, getting smacked, and then the news of tentative relaxation of rules in China. We still need to know exactly for how long or how fast they can get out of their COVID situation. But I was a little surprised that silver made it back that easy, back down to 23. I thought we were going to hold better than that. So, as you say, probably a bit of profit taking, and people wondering how good this China reopening will be. So I guess that's what the silver market was trading. But the 22 is a decent level. Yeah, 22 and a quarter should hold now, in my opinion.
I was thinking over the weekend that cable is really the leadership of the whole complex. It led the decline into the dollar top, and it led the decline weaker than euro. It led the advance, outperform euro. So when there is a correction in the dollar, it should lead, in my opinion, I think it should lead the correction.
Yeah.
Any feeling on that?
We have to be well. first of all, I'd like to see it come back to 121.5 and see what it does there. We had
Right.
the reaction of that level after the NFPs.
Yeah.
But I'd like it to be done without a special data number to see how good this 121.5 is now, around the 200 DMA as well.
Yeah. A lot of confluence, prior high.
Yeah,
And yeah.
there's a lot there, and I'd like to see it test without really getting a big figure move out of a data point to see whether it really holds for it to move higher. But I do have a bit of stuff as well up to 124. Let's say personally, I think that's the weakness of the dollar, if you look at it through the cable lens, is perhaps ran on its best legs, and I wouldn't be surprised if we at least start to range trade a little bit from now.
Okay. So Steve is here, Stell's not here. Ryan, we've heard from. Oh, I just want to show you guys, this wedge. We actually have a throw over in the gold silver ratio here. So be careful if it gets back inside. So this last decline, I didn't think it was going to be this steep, but you know what? It still is a wedge. We'll see if we can get back inside of it.
I think it does make sense that this ratio comes off if China decides to reopen because of the, as we all know, the industrial use of silver.
Yeah.
And I think it does make sense if we get reopenings, if the rest of the data doesn't completely fall out of bed, I think that ratio does make sense if it comes off.
Okay. Just hey, good morning, K-Man. By the way, how are you?
Hi.
Hi.
You want to grab the screen?
Since you guys are talking about China, do you know what the best trade that I'm not gonna take is?
The head and shoulders formation. They use the Chinese yuan.
Yes.
No, that is not it. What any other ideas?
Long crude.
No, I think a pairs trade like long, you could go the S&P and China. I think you play the China opening, and I think China is going to outperform the US equity markets from here. So
okay.
Yeah, I think that's like the best trade out there. It's not one, well, for equity market traders, it's not one that I particularly would want to trade myself, just because I just don't trade like that. But for those people that want to be exposed, in both directions, I think that's the way to play it. So, you're long China, short S&P, and if short risk moves better, the S&P is probably going to underperform, and you're going to see a sell-off in the S&P more so than you're going to see it in China. If you're playing like, some China ETF or whatever you're doing, or if you want to play long risk, it doesn't matter. Your short S&P is long China. China is going to outperform S&P. So S&P may go up, you may lose a little money. But the S&P is going to trade a lot heavier, and you're going to make more money in China. That would be like the trade that I'd want to take.
Yeah,
like
I mean that is if you're trading those equities, indeed, that would be a good trade. Or you could imagine being long China, short yen, for instance.
Yeah,
if you want to play FX.
Well, I guess you could do that. You just have to finagle it around, but yeah, I mean, you could do that too. Yeah, for sure. How would you do that? What would you do to play that trade, K-Man? Here, I'll take the
if I really would play it, because I'm still a little reluctant, but if I really would play the long China trade in FX, I mean, right?
Yeah.
No, in FX, I think the China yen is one. Because we have to imagine that China reopening is positive risk. Why don't you try something like China Swiss, or so those are the ones that I can really see straight away, or short Euro China. short Euro CNH is the one that is a possible play?
Yeah, I mean, well, first of all, that's a beautiful head and shoulder pattern. We've talked a lot about it.
Yeah, we've showed that as well on the flow.
Yeah, it's gorgeous. I mean, and now if you want to trade this, you know exactly what you want to do. You want to sell it on any rally to 7. That's just plain and simple.
Yeah, and then your stop is pretty clear above 702, 703 somewhere there.
Exactly. So that's the trade. I don't trade the US dollar CNH as an American. We don't have ability to in a lot of different platforms. However, if you're in the United States and you want to trade the US CNH, you can do it through the trader funding program. So if you guys don't know how about the trader funding, look at this. This is like totally. Dale, did you see that setup, by the way? That was awesome, right?
Yeah, it was.
But as an American, you could actually trade the US dollar CNH through the trader funding program. So if you want to learn how to trade that, you can learn how to trade our money and not risk your own money. Check out the trader funding program. I'll actually put that link in the chat box. But that's a good way, I think, to that's a good way to trade it. Would you do anything with copper?
Well, that's the other trade, right? Copper, a bit of the commodities, perhaps the as you call them, the white metals as well. They could be doing good.
I mean, look at this 200-day moving average. Look at that.
Yeah, if that starts to go, it may be may really push higher. But again, if you look at stuff like Aussie or so, for instance, that shows me that the market is still a bit reluctant to go full steam ahead on the Chinese reopenings, because Aussie had the blip when the news came out and the rest of the dollars went lower. But now we are already back around the 68. The figure it's a bit reductive. Of course, we've got RBA tomorrow, and
yeah. Well, okay. Let's stop really quick and let's talk about the RBA, because I want to talk about the RBA because I want to talk about like the Euro Aussie, which is a really interesting pair to me, because it's been this bull flag setup, and I think it's great. And I'd already told everybody in the ForexAnalytix chat room here. Let me just, so you guys can see this really quick. And I don't want to give it away, because if you're in the ForexAnalytix community, you can see it. So let me get over to the chart, and I'm just going to show you the very, very bottom of the chart. Right. I don't want to pull it up completely because, wait, is that it? Oh, that wasn't it. Okay. My favorite trade right now is right there. It's right. Yep, it's right there. So it's that one, and it's kind of similar to the Euro Aussie right now. And that was from this morning, guys, in the chat room. But the Euro Aussie is setting up really nice, and I want to bring it up because the RBA is this week. The market is expecting 0.25%, for the RBA to raise rates by a quarter point. But I guess the question I want to ask is, what if they don't?
What if they don't what?
They don't raise rates.
Oh,
how about if they leave rates unchanged?
No, well, I mean, it's not my base case. My base case is still they will 25, but they won't go the 50s or so that other central banks could still go.
But see, I don't even think that's even in. I don't even think that's in the ballpark right now. I don't even think that's even a risk.
No.
But isn't the risk like they don't raise rates, and then next thing you know, the Aussie gets absolutely pounded? But I guess the question would be, remember they were the leader really in the central banks slowing down. Very first time they were the ones that stopped raising rates as aggressive as the market was expecting. So they're the one that undershot expectations first. Right?
Yeah, actually, our RBNZ tried, but then they revised their opinion and they still went for bigger hikes. But RBA is indeed the one that really slowed down. But I'd say they will do 25 because the latest inflation data would still support a rate hike of some sort.
Yeah, no, I think that they do, and if they're taking into account China reopening, that's just going to, it's gonna give them some more price pressures, I would assume. So I think they have to look ahead of like what's happening. I know they do, and their central banks, they're going to look ahead of exactly what's happening right now. But in the event that they don't, we have to get ready for the what ifs, right? That's, as traders, that's what we do, is we ask ourselves, like, what if this happens? How are we going to, take advantage of it? And if the RBA does not raise rates and they do just leave rates unchanged, I'm buying the Euro Aussie. That's all I'm saying. Is, with this breakout in the euro, the euro is extremely bullish. The Aussie is a little hesitant here, but you can see how the euro still has some upside to complete this bull flag pattern. The Aussie is obviously hesitating. If the RBA doesn't raise rates, like the market is expecting, or maybe they come in very dovish, which could also happen. I think the Euro Aussie is just such a great setup for as long as we stay above, and it's very well defined right now. As long as we stay above this blue line, you can see it. Well, you have to go all the way to February of 2021, but you can see how critical support that is. As long as we stay above that, I think you want to play it on the long side. You get below that, then it's a different story, But those are some of my thoughts there. So with that being said, Dale, I'm gonna flip the script a little bit. What do you think about the S&P here? Because Friday we had this major channel resistance. Everybody knows about it. I know we've had these lines drawn since the beginning of since the beginning of the year, Dale. I mean, the charts have looked exactly like this.
Yeah.
Now everybody's looking at it, so everybody knows that the 4,100 level is a big deal. Do we break it?
I think so eventually, but they could slam it first. It doesn't have to break out now. We could have a risk off move with the dollar correcting, yields, like Steve said, the market, and Jim Welsh says the market didn't get it right on Powell's address at Brookings. So if we could have a risk off move first and then break it later. That's what I'm looking for. Okay,
and this move in yields, and one of the things I wanted to bring up is that if you look at the 30-year versus the 10-year, I mean, the 30-year is at really critical support here on yields, and you can see it really in the ZBs. Let me find the ZBs real quick.
And the 10-year right back at prior highs that held forever. Yeah, all that
stuff.
I mean,
this is, everybody's like focused on the 10-year, like, oh, look, it's breaking out. But I look at the 30-year and it's like, get that one up there. And then I might be convinced. I'm not really quite convinced just yet. But I think that is worth noting. So you think that stocks could go down first before we go higher? I mean, that's like it seems like a pretty logical response, because stocks will eventually go higher at some point, and they're going to continue higher at some point. But where would you be a buyer?
36.50.
Wow, you really think we're going to come off then? So you think we're going to do one of these first?
Yeah.
Before reversing. Yeah. Okay. Yeah. All right. That fair enough. Ryan, what are your thoughts there about Brazil today?
About Brazil today, it should be entertaining, shouldn't it?
What's going on there?
Hey, did you guys know? Did you guys notice that we have all these Asian teams like playing in this like they're? I was surprised actually to see Korea and Japan playing and right now. But
anyway. Don't forget that the qualifying process for the World Cup is continent by continent, right? So it's not all teams competing for qualifying. It means that there is a specific allocated number of Asian teams that are going to make it to the World Cup, irrespective of how much worse they might be from the first European team that's going to be disqualified, for example.
God, that's how us as Americans got in. I get it. Okay, very good. All right.
Oh, actually, the US team was
Just kidding. Joking.
No, we're on a
All
tough
this-
No,
content.
but let's start, we'll jump around. We got to stay away from the World Cup, although it is going to be fun games today. But Ryan, what are your thoughts about going into the market? What are your thoughts here about what's happening with you know, just FX in general? I mean, is the dollar done, you know, going down? Is this the time where you got to be a buyer?
I don't necessarily think you got to be a buyer. Let's save on the short term. I think there is signals, short-term signals popping up that we may have found the bottom, at least in some pairs like dollar yen. So I'm watching that. I'm still bearish the dollar.
So if we found a bottom in dollar yen, do you think that means we found
Yields.
a bottom in yields?
It's possible.
It is a yield play, right?
Yeah, it is possible. I mean, I still keep an eye on the 2 years. There's still the big marker, at least for short-term rate expectations. And while they're still in that, you know, 4.25 to 4.5 area, you know, it's still reflecting the ceiling, if you like, potential ceiling for Fed rates, and moving between 5 and 4.25 shows just the small market gyrations within that. Would I go screaming into buying the dollar right now? No, not at all. I still think it's going to be a rally sell, and we're seeing that. Look at euro dollar; it came off with dollar strength on the NFP, and it's ripped to new highs. The same with a lot of pairs. So I think, you know, rally selling the dollar is the way to go here still, but it takes two to make a market. So if you can find levels that are holding as support in the dollar, that's where you got to trade.
Right. You know, hey, good answer. Richard asked, he wanted to ask about this candle. Is this a hanging man candle? It sure is. So a hanging man candle is found after an uptrend. So whatever, you know, if you're in a, like in this case, you happen to be in an uptrend, and then you have a long wick with the body. Now it's hanging mans are always a little bit nicer if that like is a bigger red candle up there, but it is a hanging man. So, you know, yeah. So just, there you go. And thanks for asking. And remember, Richard, you know, you can always ask those during our private ForexAnalytix shows too, that we do on, you know, the daily roundup and the morning edge, which I know you're a part of. That's why I'm mentioning that. So, you know, Ryan, since we're here with you, or you're here, and I would just want to ask your opinion with the sterling. You know, we've had this really nice rally in the sterling. I think now everybody that you know saw the move. We had all this time to buy the sterling down at 106, 108. You know, when we talked about that move happening in Asian trade, and it didn't happen during European hours, the bottom was in. You know, we talked about that weeks ago. Here we are now at 123. Do you buy it up here? I mean, do you continue to buy it up here? Are things so great where you live that we need to be buying the pound? I mean, I want to, you know, us Americans want to know.
Again, you know, it's come a long way. It's always going to bounce more than the others because it did a lot worse than the others on the way down. You've got to match that off what it's doing in the crosses, though. You know, cable's up and flying, yeah, but you know, look at euro sterling. You know, and we're still mooching around this 85, 86, 87 area. You know, it's not doing an awful lot there. So straight away you can say, well, it's not really the pound that's really moving, it's the dollar that's really moving.
Yeah.
Would I buy cable up here? No, not particularly. Not at 123, I wouldn't. But if you get big dip down to, you know, 120s, 121 maybe, you know, that breakout point that you can see there, you've got on your chart the blue line, get down to that sort of area. That's the sort of area you want to look at.
So you tell me there's a chance.
There might be a chance. If England get knocked out the World Cup, you might get your chance, mate.
All right. Well, hey, Dale, I know you've got a really good interview coming up with Dario Perkins. He's really great. I've heard him before on like Blockworks and Real Vision. He's going to be a really great interview. So make sure you guys and gals all stick around. We do have some Canadian data. Since Stelios isn't here to ring my bell about it, pull up ForexAnalytix. If you go over here to the calendar, you can use investing.com. But the best thing to do is use the data flash that is included with ForexAnalytix. You just take that over here. Let's move it out of the way actually really quick. Let's see what that Canadian, building permits came in better than expected. And that dollar CAD, the dollar CAD, I tell you what, the loonie has held up really well. This is one of those things that I talked about during the week ahead video that you have to be really careful, because if you're playing dollar shorts and you've been, like consistently buying the Aussie, buying the Kiwi, if you're short in the dollar CAD, this thing's up in your face, and you're probably wondering, what's that? It has not paid. You're right, Dale. And so, if we start to see some crude oil weakness, or we start to see some risk off, my expectation is the dollar Canadian is going to be trading well above 137, probably closer to these highs rather than lows. So if the dollar catches a bid in any way, shape, or form, you got to be really, really careful being short dollar CAD. That just some my 2 cents there. And I am talking a bit of my book at this moment too, because I'm playing it, I'm playing it in that respect, because it's just not going down, and what does not go down usually only has one other direction to go. So guys and gals, I want to thank you all for being with the ForexAnalytix team today. I do appreciate each and every one of you. Make sure you check out the Trader Funding Program if you want to learn how to trade our money. We get payouts every week. We have to authorize payouts for traders that are now accessing larger amounts of capital and trading our capital. Remember, you keep 75% of the returns. You want to learn about that and not take any of the risk? Read or watch this 2-minute video. I'll tell you all about it. All right, guys. Thank you so much. Dale, appreciate you each and every day for being here and bringing on these great guests like Dario. I'm excited to listen to him. Make sure you all stick around for that. Steve, Ryan, K-Man.
Thank you, Blake.
Thank you, guys.
Cheers,
Thank
guys.
you, team. Thank you, team. Good way to start the week, and cap it off with Dario Perkins. Dario, welcome back to F.A.C.E. We're lucky to have you with us.
Hi.
Appreciate it. Did I mute you?
Yeah,
You're
you
good,
muted me.
right?
I'm back now. It's fine.
All right, Dario. So what's top of mind for you, Dario? With let's say our discussion today has kind of been about, it has been about that the market may have gotten the whole thing wrong on the Brookings statement speech by Powell. What do you think?
In the sense that, I missed a lot of the discussion, in the sense that it was interpreted as being a very dovish.
Yeah. Right.
Yeah, I get the impression that the Fed would love to slow the pace of tightening at this point, but it's not really in control of this. It's got an inflation problem. It's obviously watching the CPI data incredibly closely. We get another CPI reading just before the meeting. I think they would like to slow down. I think that they've done a lot of tightening, and they're desperate to actually assess the impact this tightening is having on the economy. Pretty much everyone is expecting some kind of slowdown or recession next year. And they always talk about these sort of long and variable lags in monetary policy. So they would like to take that opportunity to just sort of assess what's been happening, but it's just a question of whether the data will actually allow them. But I didn't sense anything that was sort of overtly dovish last week. I thought it was a pretty clear explanation of the way that the Fed has been thinking, and this focus on the labor market, and the idea that, over the last sort of 2 years, they couldn't really control most of the things that were driving inflation higher, but they see this fundamental imbalance in the economy, in the labor market, and that they're very much focused on trying to restore that balance of labor demand and labor supply in the labor market. And that's where they see the sort of medium-term risk to inflation. But just in terms of the pace of tightening, I think that's very much conditioned by the CPI. And then the state of the labor market probably, determines where they get to in terms of the terminal rate.
Okay, and so as far as yields came off pretty good during the speech, they have been for over a month now. Do you look for a continuation, or is this just a correction in the 10-year yield, and 435 is not the high in the 10-year yield?
Well, I mean, I'm a sort of massive bond bear. I think that we're at the start of this sort of secular bear market in bonds.
Okay.
But, you know, I think there's going to be a lot of up and downs, and we've seen enormous volatility in the economy, enormous volatility in inflation. It wouldn't surprise me if terminal rates drifted a little bit lower on a sort of trading horizon. But I think, you know, I mean, I'd be very reluctant to get into bonds just because I think the next sort of 5 years for bonds are just going to look horrendous. You know, it's not that we're in this sort of massive secular inflation outbreak, but we're going to get an incredible amount of volatility and inflation.
How about
yeah, well, we're going to get. I
issue?
think, you know, I think this year. I mean, this year's been an absolute disaster for investors because you've had, you know, 15% off sort of returns in equities, 15% off bonds. And that combination is the worst performance we've had for bonds and equities in 150 years. And I think that people have looked at that and they've sort of created these very bearish narratives about the sort of medium term and where we're headed. But I think really 2022 was a sort of taste of what we're going to get more often. So it's not that we're going to be in this sort of new normal of stagflation, but I think we're going to have a lot more periods of stagflation looking forward. You know, that sort of great moderation that we lived through over the last 30, 40 years where inflation was always low and always stable. I think that's gone. You know, when you look at deglobalization and climate change, you know, regardless of what we do with climate change,
everything,
supply chains, right? I mean, it's all, you know, well, I mean, what gave us the great moderation? It was effectively super efficient supply chains,
right?
And, you know, a series of positive supply shocks, and that's gone. And, you know, the sort of best case scenario is just volatility, and even volatility is going to be volatility of inflation going higher. So you're going to get lots more periods of transitory inflation. And, you know, if you're a bond investor in that environment, I think you get killed. And there's just no compensation in bonds for this. I mean, if you look at the term premium, it just hasn't moved at all. It's still negative. And in a sense, what we're seeing is a sort of reverse of what happened after the 1980s. So in the 1980s, you had very high levels of inflation, very high levels of volatility in inflation. And then as inflation came down, it took bond investors a long time to want to get back into bonds because they've been so badly burned. And they didn't see that the regime change that was happening. I think we're almost seeing the reverse of that. You know, and all year, people have been desperate to get back into bonds at every opportunity. And I think, you know, maybe there's another opportunity now to get back in, but I don't think that's what you want to do sort of longer term.
So this would be, you know, in your mind, even if like I'm using TLT for a proxy of the longer term treasury, even a rally back to 120, 130 is still a bear market rally. And maybe, you know, we've seen the most of it here, maybe. So specs may consider shorts in bonds. You think long term, it doesn't make sense to be in bonds, even though they could rally 20, 30% off the lows. They've already rallied 10%.
Yeah, I mean, it's about horizon. You know, if we get some good inflation data over the next couple of months, and let's be clear, it takes more than one good reading. You know, we did at least 2 or 3 for Fed officials to actually acknowledge that, you know, there's a genuine improvement in inflation. And then you've got terminal rates coming down, and, you know, that's a sort of opportunity to make some money in bonds. But over any sort of longer horizon, I think you just get absolutely killed in those markets.
Yeah. Can I ask you if you think that there's a possibility of history at least rhyming compared to Volcker, where, you know, he started his tightening regime and then paused and then had to come in and be very draconian? Could Powell be on the same course that, you know, he wants to pause for a little bit, and then, you know, by next spring, the numbers aren't better because the dollar's weaker and it's pushing up nominal prices because of a weak dollar, and that he has to come back in sometime next year and start raising rates again?
I think that's That's definitely the sort of likely outcome.
Okay.
To believe that the economy could sort of seriously deteriorate and unemployment could start to go up, and the Fed would do nothing, there's just no chance of that. I mean, there is no appetite anywhere for big increases in unemployment. And they say they've learned the lesson from the 1970s and the 1980s. But you have to remember that back in the early 80s, we'd had 15 years of stagflation, and people were absolutely sick of inflation. You had the unions continuously on strike, and so there was sort of this political desire to crush the trade unions, and there was a sort of widespread acceptance that you needed big increases in unemployment to do that. And you had sort of Reaganomics in the US and Thatcherism in the UK. And this is just a different world. To believe that these central bankers are just going to say, well, unemployment is going up and that's great, it's just not going to happen. I think that they will capitulate very quickly. And obviously they deny that because at the moment they're very much focused on inflation. They're raising interest rates. They want everyone to focus on the fact that they're raising interest rates, not the fact that they'll be cutting interest rates. But if the economy really starts to crack next year, then they'll respond to that. They always do. And chances are they'll freak out and sort of overdo it. I mean, I actually think the economy will be quite resilient. I think that people are sort of too bearish about global growth prospects. If anything, everyone keeps revising up their forecasts. You look at Europe, the data keeps coming in a little bit better, and then people keep cutting their forecasts for next year. I think we'll see some resilience here, actually.
So you think risk, bonds are one story, and risk and equities, and it sounds to me like you would prefer equities outside of the U.S. Could that be because of dollar weakness? And do you think that the dollar, Dario, has put in a major top up here at this 114 level? Pretty vicious break we've had so far. Is that it for the dollar for a while?
Well, I think we're in a quite simple world to understand the dollar now, because we were in this reverse currency war, since we're really from the spring onwards. And it was never really credible, but central banks in Europe sort of peddled the idea anyway. And they believed that they could defend their currencies by matching the Fed 1 for 1. So every time the Fed did 50, they did 50. The Fed did 75, they did 75. And I think they've got to the point now where these European central banks, apart from the ECB, which is still living in a sort of fantasy land, but the other central banks realize that they can't match the Fed anymore, because their economies are much less resilient to interest rates going up. And so what we've seen is a bunch of central banks, starting with Australia, Canada, Norway, and then the UK. They've all sort of already pivoted. They've already signaled that the reverse currency war is effectively over. And the reason for that is that they've got massive domestic vulnerabilities, massive housing bubbles. Each of those countries is basically the sort of prime candidate for a housing bubble. And they've realized that, that their economies are much more sensitive to rates because they have a lot of variable rate mortgages. And that's not a problem that the US has.
That's true.
So, you think about the impact of interest rates going up, you have a sort of flow effect, which is the immediate increase in interest rates and the effect that has on mortgage activity and housing construction and all of that. We're seeing that everywhere. I mean, that's pretty universal, that housing markets are now under pressure. But then you have this stock effect, which depends on the nature of your mortgage market. And if you've got huge amounts of variable rate mortgage, like Australia, New Zealand, Norway, UK, Canada, then you get this extra effect because you're squeezing the incomes of people that already have mortgages, and you're pushing them closer to financial distress. So if you think about the sort of big short dynamic, what was the big short? Well, it was the sort of US hedge funds looking at US mortgages and figuring out that 30% of those mortgages had been variable rate. And they all timed that 2006 sort of ticking time bomb when all these mortgages were going to blow up. Well, you don't have that dynamic in the US at all, but you have it in a whole bunch of other countries. And those other countries have now realized that they're just at the mercy of the Fed here. And they've realized that their currencies are going down either way, because, if they don't match the Fed, their currencies go down. If they do match the Fed, they blow up their domestic housing markets and their currencies go down. So those central banks have realized the futility of this, and they've all sort of given up now. And so now, currencies are just entirely a play on what the Fed does. If the Fed pauses or slows down its tightening cycle, that's going to take the pressure off all of these other currencies. If it doesn't, then those currencies are just going to continue to get hammered.
Well, they haven't been getting hammered for a while. I mean, the pound, you're in the UK, right?
Yeah.
Okay. So, what do you think about a 123, 124 pound from 103? Do you think that it's becoming overvalued up here?
Yeah, so I think the pressures. I don't think it's overvalued. I think the pressure is coming off because of the Fed, because there's this perception that the Fed is going to slow down. There's this. The Fed is now clearly looking at the data again, which it wasn't doing for a period, and so the idea that the Fed is about to slow down is taking the pressure off all these currencies. In the UK, we were in this sort of ridiculous crisis for 2 months, and there's been a lot of stuff written about that, sort of fiscal black holes and the bond vigilantes, and all of that was nonsense, really, because all it was is that we had a very aggressive government, and it looked like the Bank of England would raise interest rates very sharply in order to deal with that. And at one point, we had a terminal interest rate of 6% in the UK. And there was no way that the Bank of England could raise interest rates to 6% without crashing the entire economy. We're looking at debt servicing ratios for households, jumping to sort of 50-year highs. And it was obvious to everybody that if the Treasury had continued on that path and the Bank of England had continued on the path that they were on, we were going to get, some sort of financial calamity. And so if you're an international investor, you just dumped sterling at that point. So what we've had now, because you didn't want anything to do with UK assets in that sort of environment, if the UK is facing this sort of immediate trade-off between price stability and financial stability, then you just dump it. So I think that we'd sort of oversold, and there was a sort of, we were just in a sort of crisis situation.
Yeah.
And that dynamic has been broken because the Treasury has reversed everything and is talking about austerity, although there's no genuine chance that the UK can do austerity. I mean, it's ridiculous, but they've managed to convince people that they will. And
How
the Bank
can they
of
do
England,
austerity with an energy crisis in the UK?
well, they can't. It's nuts, and at the moment they're doing, they're still doing more fiscal support. I mean, even now, as temperatures are dropping, there's a sort of tap of government money flowing into the economy with every degree that the temperature falls. But they've managed, but the UK was becoming this sort of market narrative. We were this joke, and we have lots of clients based all over the world. They were continuously ringing me up saying, what the hell's happening in the UK? We'd become a market theme. And so what the government has managed to do is to stop us from being a market theme. And we've gone back to being sort of irrelevant again. Nobody's interested in the UK anymore, which is exactly what they needed to do. So they've managed to convince people that they're doing austerity. In turn, the Bank of England is signaling that it's going to be much more gradual with raising interest rates. They've made a real effort over the last sort of month to tell people that the market is too hawkish on interest rates and that they're not going to hike as quickly as the market expects. And so that sort of trade-off between financial stability and price stability has gone away, and gradualism has come back, and sterling is rallying on the basis of that it looks like, we're in a sort of more sensible world for policy. And it wouldn't surprise me if it ran further, but I think that we'd overshot, when sterling had fallen to its sort of lowest level in history, we were undershooting, and we've just bounced back, and the government has done the smart thing, but we still have a fundamental growth problem in the UK, and there is no chance that austerity is going to happen. I think the government will have to do more at some point, not less.
Do you think the Fed cares about what's happening in the precious metal market at all? The recent rally in gold and silver, do you think it's just a spec play, but because central banks have been pretty heavy buyers of gold for years, but even really stepped it up over the last 3, 4, or 5 months. What do you think is behind central banks really being aggressive?
I don't think that's a big focus for them. I think that they've been looking at financial conditions much more broadly. I think that as investors, we sort of think that central banks are more interested in financial markets than they actually are.
Okay.
I think that we're sort of talking our own book sometimes with central banks. I think they, I used to work in policy making, and obviously they do look at what's happening in financial markets. But the idea that the Fed has to sort of target a particular set of financial conditions or target a particular level of the stock market, the fact that stock markets are rallying now is sort of unhelpful for the Fed, but I don't think they can really over-engineer that. I think the focus for these central banks is very much on the inflation that they have and on the level of interest rates that they believe they need to sort of deal with that inflation problem. And then everything else just drops out of that. And so, the idea that the Fed can't slow down its pace of tightening because, the equity markets might rally, I don't think they'll be looking at it that closely, actually. I think they'll be much more focused on interest rates, and they need to know that their monetary tightening is still where they want it to be. And that's much more about interest rates than it is about, any commodity
or equity index. Because, that has been bandied about by, some respected people like Julian Brigden, saying that the economy is so financialized that for the Fed to get employment down to the levels, or unemployment up to the levels they want, they would have to take the S&Ps down to 3,000, 3,100, the pre-COVID levels. You don't think that there's that type of linkage between the market and the economy, that it's so financialized, the economy, that lower stock prices are going to be needed for economic indicators to go their way?
I think it's been helpful this year that the equity market has gone down. I don't think the intention was to sort of target the stock market in that way. It was also, I think they were also hoping that it would have some effect on labor supply as well. So there was this idea that lots of older people had retired because they could afford to, and maybe you could push those people back into taking jobs. But I think the focus is much more on interest rates. And when you look at the sort of transmission mechanism of monetary policy to the economy, it's coming largely through housing. So, we're seeing this very aggressive deterioration in housing activity. Almost all of that is because of, what these central banks have been doing. And that's the bit that they need to sort of control. It's housing and durable goods. And I think if you start to get sort of job losses in those areas, then you get a sort of much more tangible impact on the economy than sort of indirectly through stock markets. I think they don't really understand the impact of stock markets on it sounds weird, but I don't think they really understand the impact of stock markets on the real economy. Is it wealth effects? Is it confidence? Is it balance sheets? It's all a bit sort of up in the air. And I think they're much more focused on the bit they understand, which is just interest rates, housing, lending. It's that sort of transmission mechanism.
Yeah. So really haven't had big price falls because of the factors that you mentioned about, most people in the US have, locked in their rates under, 3.5% over the last few years before this tightening cycle. And there's no way, unless they're completely unemployed, that they're going to lose those properties or sell those properties, because for them to even go out and rent, it would be twice as much for them to do so.
Yeah, but
how do you break a housing market that has that setup of being short housing stock and people locked in? Go ahead.
No, but so what they have done is they've killed transactions. So, new mortgages has tanked, house purchases has tanked, housing construction has tanked, any sort of employment related to those sectors has stopped. So they have had a very tangible effect on the economy, sort of directly through that channel. it's it's just a question of how far that goes, and do you start to see sort of big job losses in those sectors, and there are all these sort of potential spillovers that you can get, and you can get a sort of plain vanilla recession coming from the housing market without having the sort of massive financial distress that you had in 2008. And I think that's why the US looks a little bit different from some other countries, because the chance of getting sort of subprime dynamics in the US is pretty remote. But just through sort of construction and durable goods spending and furniture sales and all of that stuff, you could still have a pretty big effect on the economy. You could still slow down activity and employment in quite a big way doing that. But if you're Canada or the UK or Australia or any of those countries, you get that, but you get an extra effect, which is that you're squeezing the spending of anyone who owns a home. And if those people have over indebted themselves, and a lot of people have, then maybe you actually get financial distress on top of that.
Okay. All right. Interesting. Why don't we wrap it with what you said the Fed knows, and that's interest rates, 0.5 point for the next Fed meeting?
Yeah, I mean, it's looking that way. It's looking, but it doesn't help that they get the CPI data just before.
Right.
As I said, I think it's that they clearly want to slow down. I think that they've hiked a long way. They haven't really been assessing the impact on the economy. They know that there's these lags. They know that stuff is happening in housing. They think that labor demand is weakening, but it's not entirely clear. They'd really like to take stock of it. But, if they get a really nasty CPI print again, they're going to find it really hard to do that.
What's an investor to do in this environment, Dario? Do you think that it's more important right now, after this transition year, which is coming to a close, to be focused on return of capital instead of return on capital?
I think so. I think this is the most difficult environment. Well, I think this is the most difficult environment I've ever seen. I mean, I've been doing this 20 years. I've never seen an economy as confusing as the one that we're in right now. Investors are constantly saying to me, where are we in the cycle? Well, the fact that they're asking that question just sort of highlights how difficult this is, because this isn't really a cycle. No point has this been a normal business cycle. This is a sort of messed up, pandemic affected, war affected global economy. And it's really difficult. And central banks have sort of added to the volatility by freaking out about inflation this year and raising interest rates too quickly. So all of this stuff has to unwind. I feel much more certain about where the world is going sort of over the next 2, 3, 4, 5 years than I do where it's going over the next 6 months, which sounds bizarre, but I just think we've got these massive distortions in the economy. And as these distortions unwind, this data is going to be all over the place. And I think it's just going to be a world of huge volatility.
Optimistic after we get through this 6-month period?
I think so. I think that I think it's going to be very different. So, I think we're in that sort of secular higher interest rate world. I think inflation will be higher, but it will be more volatile, which is probably the biggest story there. But I think it changes everything for investors because, for the last decade,
you can't
as
just
an investor,
FANG
you just put money into US tech and you just watched it getting continuously re-rated. And this is going to be a much more difficult world, but there's going to be huge opportunities in that, globalization, climate change, reshoring, building back of manufacturing. There's going to be plenty of opportunities out there for investors. It's going to require a little bit more sophistication than it did.
Yeah, you're actually going to have to do some work.
Yeah, and a lot of investors are sort of value investors or bottom up, and they've got absolutely hosed, and they've just seen sort of a younger generation of investors come through that have just been putting money into Tesla or whatever and watching it go to the moon. And they've been utterly frustrated over the past decade, but that decade is really unusual. You can look at sort of the composition of the stock market going back to 1930s. That period where growth just absolutely killed value is just incredibly unusual, and it is just a feature of a sort of lukewarm, disinflationary economy with a horrible policy mix. And I think that world is gone, and I think it's going to be very different.
Okay. Well, it's great to have you come and edify our community about these things, because we don't feel alone when we hear about all these people that are confused about what to do intermediate term. We have to get through the mud of the next 6 months, according to you, Dario. And you're a great watchman for the FinTwit community, and appreciate you giving your time and explaining what you see to us every time you're here.
No worries. Good to talk to you.
All right, Dario Perkins, everyone, and you could follow him at Dario Perkins, right? Best place for people to ask you questions or get a hold of you. Is that correct?
Yeah, Twitter's the best place. I'm on there quite a lot. And
all right.
Yeah.
All right, you tweeter. Happy holidays to you, Dario.
You
and
too.
Yeah, and Happy New Year. Thank you very much for being here today, and look forward to talking to you in a few months.
No worries. Take care.
All right, Dario Perkins, everybody. And everyone could join the team in 15 minutes on the Morning Edge. You're welcome. People appreciate that you were here. And Dario, and I'll see everyone tomorrow for Turnaround Tuesday. Adios, everyone.